Hello and welcome to your daily note for September the 30th, 2022. So, we did get some data that came through. We got pending home sale data that was down 24.2% compared to the prior of minus 19.9. We had initial jobless claims coming in better than expected. The forecasted estimate was for 215,000, a slight rise from the prior month of 213. But when it came in much lower at 193,000. And then finally, we got the GDP growth rate revisions for the second quarter, which remained the same at minus zero point 0.6. So all of this data, I think, at least this week, besides what we're going to get today, continues to highlight the slowing economy, continues to highlight the slowing the slowing housing market, as you've seen the Case-Shiller Home Index come down, as you've seen pending home sales come down. It also highlights the slowing of the manufacturing sector from the Chicago Fed, Dallas Fed, and durable goods orders. And then finally, the still resilience of the labor market in the fact that initial jobless claims continue to drive a little bit lower. I wrote a little bit about that yesterday in one of our data points articles in highlighting the labor shortage. We're in a situation where labor demand is very, very near the total labor force supply. That creates a very tight labor market, which is creating this wage inflation that we're experiencing right now. And the Fed just doesn't want to get it out of control. They don't want to get into that wage price spiral, which could stick some of the prices for a little bit longer. It's a concern because wages are contractual obligations. So if you think about it, when someone gets a pay raise, they don't get it for just that one moment in time. They get it for a full calendar year. And some contracts are negotiated for multiple years. And so that is something that we have to keep in the back of our mind when we think about the labor market and we think about wages. Today, we're going to focus a little bit on economic growth and look at those revisions. So again, it did come in at minus 0.6 compared to the forecast of minus 0.6, which is exactly where it came in whenever we highlighted the second quarter. What changed? Really not too much. The upward primarily reflected an upward revision to consumer spending that was offset by a downward revision to exports. Imports, which are a subtraction of the calculation of GDP, were revised down. If we come down here a little bit further, the decrease in real GDP reflected decreases in private inventory investments. So real quickly, we talked about this, but there was so much inventory broadly that we started to see a drawdown in that inventory throughout the second quarter. We saw a slowdown in residential fixed investments. So again, housing slowing down. Saw a slowdown in federal government spending. There's no more stimulus checks. There's no more support. And then we also saw a reduction in state, local government spending. These were somewhat offset by increases in exports and consumer spending. So that was something that was actually holding kind of a floor underneath GDP. Now, if you come down further, though, and you look at the personal income side, disposable income did increase, as well as current dollar personal income also increased. When you get to the real part where we adjust it for inflation, it did come down. So that does highlight these inflationary pressures might be waning on the consumer balance sheet a little bit. And then also the personal savings rate was revised downward as well, in change of 78 billion from the previous estimate. So the personal savings rate was 3.4% in the second quarter, a downward revision of 0.4. So the fact that consumption increased in the second quarter, but yet incomes had a tough time keeping up with the inflationary pressures that we're experiencing tells us that consumption might be in trouble going forward from here. And if you already have reductions in inventory, reductions in investments, government spending, and state and local government spending, well, the only other shoe that's going to be helped here is exports. If you see consumer spending fall, that's what's giving us at least some level of confidence to say, hey, Q3 might come in slightly negative. It might accelerate from Q2. You can see our estimate for Q2 was minus 1.7. It actually came in at minus 0.9 before the revisions here to minus 0.6. And then here we're looking at minus 0.4. So again, a slight acceleration. And I think that matches what you're also seeing from like the St. Louis Fed as well as the Atlanta Fed GDP nowcast estimates. You can see that as of Q3, the St. Louis Fed is at 0.55, the Atlanta nowcast is at 0.27, and the average of those two is for 0.41. That's a hard slowdown from the second quarter, which the average was 1.44. So again, a continued slowdown in real GDP. It continues to highlight why we remained so defensive, because the economy was still slowing. We're not seeing any big changes, but I will say that the market made a rotation throughout this quarter. We're going to come back to the PCE estimate and what's coming out today, but I want to come down here and just highlight for the quarter. So from July until yesterday, September 29th, we saw something very interesting on the quarter to date performance. We saw high beta, momentum, triple Qs, and growth outperform low volatility, quality, dividend payers, defensives, and values. I think that's something we can't ignore in the face of, hey, the economy's still slowing down, so that means you need to stay defensive. But when the market starts to move, it looks like it's starting to move in the direction of that growth-oriented mindset. I'm not there yet, right? I think that's an interesting finding, and we're going to have to watch the rescaled ranges. We're going to have to watch market correlation. We're going to have to watch risk reward plots to see if we start to see some of things elevate to a more natural risk adjusted basis. But it's an observation that says, hey, look, the market's finding value in that growth sector despite the economy slowing down, at least in the last quarter. Now, all of them are still negative. It's still very bearish out there. We've seen that on the AAII sentiment indicator, but this does point to at least some stabilizing in the large sell-off you've seen, because high beta is down 30, triple Qs are down 34, gross down 32. So you compare those to down 13, down 11, and down 16, and it's a really difference whenever you look at the whole calendar year. So we're going to keep that on the forefront as we get more data, because if we do see the economy softening from here, if we do see the economy turning, I would expect that trend to continue. Again, we're not there yet, so remain defensive for now. What's coming out today? You're going to get the PCE price index. You're going to get personal income, and you're going to get the Michigan Consumer Sentiment Report. We already have a preliminary report from the Michigan Consumer Sentiment Report, so I'm going to highlight that here. Here's consumer sentiment from Michigan. Let's just jump down here to the survey of consumers. And they're already coming in at 59.5, so a slight increase from August. Again, this is preliminary, so we'll have to see what the actual results come out as. Consumer sentiment was essentially unchanged in September, just 1.3 index points above August. The one-year economic outlook continued lifting from the extremely low readings earlier in the summer, but these gains were largely offset by modest declines in the long-run outlook. Personal finance components of the index, as well as buying conditions for durables, remained at similar, relatively low levels from last month. After the marked improvement in sentiment in August, consumers showed signs of uncertainty over the trajectory of the economy. So there's really not much that's changed here, but this is what I really wanted to highlight, because we are talking about inflation today. With continued decreases in energy prices, the median expected year-ahead inflation rate declined to 4.6%, and that's the lowest reading since last September at 2.8%. Median long-run inflation expectations fell below the 2.9 to 3.1% range for the first time since July 2021. However, it's unclear if these improvements will persist as consumers continue to exhibit substantial uncertainty over the future trajectory of prices. Uncertainty over short-run inflation reached levels last seen in 1982, and uncertainty over long-run inflation rose from 3.9 to 4.5 this month, well above the 3.4% level seen last month. I think this is a fear of the Fed, their fear that inflation becomes anchored in consumers' decision-making, the fear that, hey, I want to get these transactions done before prices go further. I think a great example is what we saw this week when we saw when we saw new home sales accelerate. 685,000 sales versus the estimate of 500,000 compared to the prior 511,000. There could be this, hey, let me get this house purchased before rates go up any higher, right? And so when that happens, you could have some level of demand that's accelerating pressure on inflation because people want to buy things sooner, get those larger transactions out of the way because they're afraid prices will drive higher later. Now, that's a perfect segue into our PCE price index estimate. So you're seeing that year over year, prior was 6.3. We are showing that it's going to further deteriorate. This is the actual PCE price index. I'm going to show you the core PCE, which strips out food and energy. When we strip that away, I'm showing 4.45, a lower forecasted estimate of 4.18, and an upper forecasted estimate of 4.71. So core, of course, is just a little bit lower than the headline number of 6.3, but it's definitely something that you're seeing a continued slowdown here. But I really want you to focus on the upper forecasted estimate. You see how it's possible that it could accelerate a little bit more through September before it starts consistently heading south from October through December. And then the lower forecasted estimate does get in the twos if we see a harder reduction in inflation. You do need demand in the economy to slow down further, and I think the economy's been very resilient in the third quarter here, which is why we have a slight increase in our GDP estimate. But still, it's definitely something that if inflation doesn't break hard lower, you're going to continue to see rate hikes, and you're going to continue, um, and you're going to continue to have pressure on the market from those rate hikes. So definitely think that inflation is going to continue to deteriorate. I'll show you just real quickly what Estimize estimates are looking at core PCE price index. So the current estimate is for 0.2. There's a pretty wide range, 0.1 to 0.5. We're coming in at 0.1, so we expect it to slow down. We were pretty steady at 0.4, 0.4, 0.4, and you saw some big gyrations. You saw 0.3, 0.6, and a reduction to 0.1. So the average of the last three was pretty close to 0.4, but now we're probably seeing a deterioration here. And there could still be some surprises. We've highlighted electricity being stubborn. We've highlighted rent prices being stubborn. We've highlighted food at home prices being stubborn. So those will be some components that we look at in the PCE price index today. One last thing I'm going to point out, and I think it's going to be a perfect place for us to stop and wrap up the week here. We're going to come all the way back down here to our FedWatch information. I'm sorry, two more things. There's a lot that's going on and a lot that's moving here. Let me first point out volatility. We highlighted earlier in the week, I believe on Monday, that volatility was increasing. Well, there's two other ways that you can look at volatility increasing outside of just looking at the VIX. Of course, we highlight it every week, but high yield option adjusted spreads have started to move back upward again, which have put downward pressure on the stock market. But I want you to focus on triple Bs. Triple Bs initially rose at the beginning of the year up to a level where we've seen prior peaks, which is around 2. You can see that we're back there again. So if we don't materially start to move lower on the triple B index option adjusted spreads, and we continue to see those break out as well, that's going to continue to highlight higher volatility. The volatility, I think, is coming from funding markets and from liquidity issues. If you look, the Fed is draining liquidity very quickly. We just finally got the update yesterday of the balance sheet reserve balances, and you can see how the reserve balances came down even further, and we're approaching that currency in circulation floor. In fact, if you come down here, before it was roughly 800 billion, now it's about 600 billion, and that's only going to give you about 7 months of being able to roll the balance sheet off at $95 billion a month. That puts you in like this April-May period. So definitely that's probably a turning point and why everybody's thinking the first part of the new year. But something to think about, as liquidity drains from the system, you're going to probably have more stress on the financial market through the credit markets, which is why spreads are widening. It'll put downward pressure on the stock market, which eventually should start to lead the turn of people coming out of the market into the bond market, and we should see some of that market correlation come back. We'll highlight that on Monday as we close the week. But there's a lot of moving parts right now, so definitely stick with us. We'll continue to bring you these updates as we get them. But it's pretty clear that the economy is slowing, the market is struggling, and at present moment, there doesn't seem to be a lot of signs of a turning point. Although we're consistently looking for those and trying to find them. So again. Thank you for taking some time out of your day to watch these. If you have any questions at all, don't hesitate to shoot us an email, leave us a comment below. We'll be happy to answer those for you. If nothing else, have a great weekend, and we'll be back on Monday with another update.